Max, when you look at, I guess, the market movements, what exactly is priced in? I don't know if people go for valuations or there's just a general sense that the economy is ticking along nicely and so equities will go up.
Yeah. Yes, I think what's happening right now is that a lot of the momentum trades that have worked in 2017 are still sort of carrying over, right? So what you see is tech is still rallying. You see some of the financials really doing well on expectations of the tax cut. What you also see is cyclicals are actually doing well. They're outperforming the bond proxies, defensives. So what you see is it's a continuation of the expectation of sort of very good growth but disinflationary. And that's obviously a very good mix. And that's the sort of mix that people expect also to happen in 2018. And therefore, equities are rallying further.
OK, and I want to get into the economy in a second. But overall, is this the year, depending on what inflation does, and I want to ask Simon about that in the Fed, where you could see a rotation, away from bonds?
Yeah, I don't think so. I think what we have seen, and that should have actually happened already in 2017. So in 2017, everyone was saying, look, bonds don't make sense more, credit doesn't make more sense, high yield, and still high yield spreads were tightening. You know, euro high yield is now yielding sort of 2.5%. So we're on fresh ultra cycle lows there. And let's say an outright rotation away from bonds to equities would need actually a switch from the disinflationary really good growth to more of an inflationary really good growth. So really good growth, but with a mix of better than expected inflation. And then you could see a more sustained rotation from bonds to equities.